Money is an invisible fuel that drives the modern world. Have you ever taken 1 second to think about how this whole machine operates? Let's start at the beginning. You earn your paycheck. It goes into your bank account. The bank lends money out to companies based on that money. The companies build buildings like a skyscraper, hire hundreds, thousands of employees, and those employees earn their paychecks and put money back into the system. And the cycle continues. The money does not go into a single type of institution. That money flows through commercial banks, corporations, government entities, insurance companies, investment banks, pension funds, mutual fund companies, hedge funds for high net worth individuals, private equity companies and/or venture capital firms. You now welcome to the financial system, a huge web of many institutions that create, transfer, and replicate money across the globe in ways most people have no idea exists. This video will cover the roles of the large players involved in the financial system, the functions each player performs, and how the players interact with one another to keep the global economy operating smoothly, and sometimes not as smoothly. At the end of this video, you should have a broad perspective of the entire global financial community and understand exactly what the very large organizations of the financial world perform. Let's begin with the place in which money is initially produced. The primary role of central banks in an economic system is to act as the governmental entity that oversees the financial system and ensures that the laws of the system are followed. Every country has its own central bank. For example, the United States Central Bank is known as the Federal Reserve, while China's is the People's Bank of China, and the United Kingdom's is the Bank of England. These entities perform many functions, but in simple terms, the function of central banks can be viewed through the lens of controlling the direction of an economy by utilizing monetary policy. Monetary policy involves two main areas of control by a central bank: the total amount of money available within the economy and the rate at which interest rates are set by the central bank. These controls are used to meet three major objectives of the central bank: price stability, or low inflation, full employment, and general health of the economy. Now let's think about how this plays out. If the economy is slowing down, the central bank will step in to use an economic strategy called expansionary monetary policy. It's like turning on the faucet wide open and flooding the economy with money. In order for them to do that, they would lower their interest rates, making borrowing money less expensive, buy financial assets on the open market, or simply create money. When interest rates are lowered, it becomes easier for companies to borrow money at cheap rates to increase production. Individuals can get mortgages at better rates, and money begins moving around much quicker. When people have more money, they spend more. Therefore, production increases, more jobs become available, and wages increase. Therefore, when there is more money in people's wallets, they consume more, and the entire economy picks up speed. That's why presidents such as Trump are often eager to put pressure on the Federal Reserve to decrease the interest rate. A fast-growing economy gives the president a positive image. There is a trade-off to this. While too much money in an economy causes inflation, due to price inflation, excessive spending can result in higher inflation levels. Therefore, when interest rates are high enough to reduce demand in the economy, central banks will use contractionary monetary policies to lower inflation levels by increasing the cost of borrowing through increased interest rates and/or using quantitative tightening to reduce the money supply through selling bonds on the open market. Quantitative easing and tightening both represent types of open market operations used by central banks to add or remove money from the economy. When central banks sell U.S. Treasury securities, they take money out of circulation and hold it as reserves at their respective central banks, therefore reducing the amount of money available for spending, etc. Conversely, when central banks purchase U.S. Treasury securities, they are putting additional money into circulation, thereby adding to the money supply and increasing spending, etc. Central banks are the puppet masters of today's economies, controlling the money supply and setting the stage for all other economic activities to follow. Thus, it is no wonder that everyone pays such close attention to interest rate decisions made by central banks. The focus will be on commercial banks. Central banks are the puppet masters, while commercial banks are the workhorses, i.e., they do all the hard work. Examples of large commercial banks include JP Morgan Chase, Wells Fargo, Bank of America, etc. Commercial banks are typically the location at which you place your money for the long term. Your check is deposited into your commercial bank, your credit card company receives payment from your commercial bank, and your commercial bank facilitates your car loan and/or mortgage financing. However, their true function is to act as an intermediary between savers and borrowers. Think of it as follows. On one hand, you have individuals, companies that possess excess funds, e.g., everyday people with excess money in checking accounts, retirees receiving monthly pension payments, corporations with excess profits. On the other hand, you have borrowers, e.g., startups seeking funding, families seeking to purchase homes, corporations seeking to grow. Commercial banks exist to facilitate lending by collecting idle funds from savers and making these funds available to borrowers. This activity enables funds to circulate and be used productively rather than remaining dormant in a depositor's account. However, commercial banks do not simply lend on deposits. In fact, when a commercial bank creates a new loan, it creates new money. Historically, this process has been described as being facilitated by reserve requirements. For example, if a bank had a 10% reserve requirement and held $10 million in reserves, it would be able to issue $100 million in loans. Today, in many major economies, the reserve requirement is essentially 0%. While banks cannot lend without some limits imposed by capital requirements and liquidity regulations, the fact remains that commercial banks increase the money supply when they lend. Therefore, they are the lifeblood of the modern financial system. And although your pay goes into a commercial bank, there are also pension funds that typically take nearly 10% of your pay before your pay reaches you. Pension funds are essentially big investment pools that will help ensure that people continue to have income after they quit working. They're also the largest financial entities on Earth. With over $60 trillion combined, they have the responsibility of growing the money that workers will invest over decades so that retirees won't run out of money. And they obviously do not place their investments in a standard savings account, earning 2% interest. This would be silly since they seek to earn approximately 6 to 7% per annum. And they achieve this through investments in everything: stocks, bonds issued by governments, bonds issued by companies, and large-scale real estate ventures. Large-scale real estate ventures are not small house developments. They are literally landmark developments such as the Ontario Municipal Employees Retirement System's ownership of Hudson Yard, Olympic Tower in New York City, and large resort hotels in Canada. Additionally, they also invest substantial amounts in hedge funds, venture capital, and private equity. In fact, pension funds represent the largest source of capital for both private equity and VC firms. Therefore, even if you rarely give thought to pension funds, they are having a significant effect upon the global financial systems. Next, we have another heavyweight: mutual funds. Let's first pause for our sponsor. Money Mechanics uses Chat LLM from Abacus AI, which has truly made a difference in my workflow. Money Mechanics integrates the top large language models into one platform. Previously, I had multiple Windows tabs open: ChatGPT, Grok, Midjourney, etc. Now, everything is located in one location. I could ask a question like, Ross Ulbricht lost how many bitcoins when Silk Road was shut down? And the system will send it to the best model for answering that particular question. In this case, ChatGPT 5. Additionally, I can choose to have the answer rewritten by Claude or Grok or any other model available at any time. What is crazy about Money Mechanics? It provides me access to all of the above models for $10 per month. Grok costs $30. ChatGPT is $25. Claude is another $30. Midjourney is $50. Money Mechanics gives me access to all of them for $10. It also creates images and videos with incredible power. If you wish to save money and speed up your workflow, please visit the link provided in the description. Thank you to the entire Abacus team for supporting the channel. Back to the video now. Mutual funds are simply investment clubs for average folks. You do not require millions of dollars to invest in the same way that a hedge fund does. Anyone can invest a couple $1,000s and gain access to the expertise of professional managers. These include Vanguard, Fidelity, BlackRock, the three giants. They collect money from thousands of investors and use it to purchase massive baskets of assets, stocks, real estate, bonds, etc., depending on their strategy. They are very similar to pension funds, but much more flexible. You may add or subtract money at any time. However, when you invest in a mutual fund, you actually become a shareholder of every asset included within the fund. If you invested 0.005% of a $100 million fund, and the fund grew by 5%, you would receive $250, minus any fees. The major benefit of a mutual fund is diversification. It would be absolutely crazy to attempt to divide $5,000 among 500 different individual stocks yourself. A mutual fund does that for you. Mutual funds are categorized as either actively managed, in which analysts attempt to outperform the market, and passive, in which the fund tracks the performance of an index, e.g. the S&P 500. Passively managed funds are less expensive because they do not need a team of high-paid finance professionals to guess which stocks to pick. While mutual funds are available to the public at large, the wealthy elite invest in hedge funds such as Bridgewater, Citadel, and Jane Street. These hedge fund investment vehicles are only open to accredited investors, which means you have to have an income of $200,000 plus per year, or a net worth of over $1 million, not including real estate. Why? Because these hedge fund managers take enormous risks. Their investment strategies are based on speculation. For example, they can be betting that a stock will go up in price, but also simultaneously wagering against the same company's stock price. Hedge fund managers place bets on currency fluctuations, interest rate changes, commodities, such as oil, cryptocurrency, presidential elections. You get the idea. They utilize substantial amounts of borrowed capital, therefore creating massive returns through excessive leverage. In addition, hedge funds buy and sell derivative contracts such as options, futures, and swaps. Some hedge fund managers use unorthodox investment strategies. However, these strategies can result in massive gains or massive losses. Notably, approximately 85% of all hedge funds fail to exceed the returns provided by the S&P 500 index. However, the few hedge funds that do succeed, such as Jim Simons's Medallion Fund, generate returns far in excess of what Warren Buffett has ever generated. However, this success is often accompanied by enormous costs. Hedge fund managers typically receive 2% of each investor's total portfolio, as well as 20% of the profits generated by the manager. On the next block, investment banking. Investment banks, Goldman Sachs, Morgan Stanley, Citigroup, act as the Wall Street matchmakers for corporate, government, institutional clients and facilitate the movement of large sums of money for these clients. Although investment banks technically can perform many functions including trading, providing loans to hedge funds, and offering securities, investment banks are primarily involved in the areas of going public through an initial public offering, IPO, mergers and acquisitions, M&A, and capital raising for corporations. Investment banks assist the corporation in the process of issuing stock through an IPO by evaluating the worth of the corporation, preparing and filing the necessary documents with the regulatory bodies, and marketing the corporation to potential investors. During the 2012 IPO of Facebook, Morgan Stanley assisted in raising $16 billion on one day, which would represent the gross domestic product of a small country. Investment banks also assist with the negotiation of large-scale M&A transactions, preparation of due diligence reports, and compliance with applicable laws in order to determine if the transaction is legitimate, i.e., verifying that the person you have just met is who they claim to be. Additionally, investment banks will assist corporations in obtaining financing from the capital markets by assisting with bond issuances, equity sales, and large-scale loan arrangements. At times, investment banks find themselves at the center of scandalous activity, such as the case of Goldman Sachs' assistance to the Malaysian 1MDB fund in the issuance of securities that were later determined to have been stolen. In addition to these public players, there is a significant role for private equity. In essence, private equity firms are like house flippers, except they are flipping companies as opposed to houses. Private equity firms collect large amounts of money, borrow much more, purchase companies, reduce costs, restructure the operations of those companies, and attempt to resell them all for 3 to 5 times the price they purchased them for. Large firms such as Blackstone, Apollo, and KKR collectively have the management of hundreds of billions of dollars, and Blackstone has surpassed $1 trillion in assets. A key component of this model is leverage. For example, if a private equity firm purchases a $100 million company with only $20 million of their own capital and borrows the remaining $80 million, they will then place the $80 million in debt on the company itself. And if the company fails or falls apart, so be it. The private equity firm only had 20% of its original investment at stake. This is referred to as a leveraged buyout, LBO. Once private equity firms have taken control of a business, they typically fire or remove the previous management team and eliminate any departments that do not generate a profit. In addition, they will continually look to maximize profits from the company. If successful, they will ultimately sell the company many years after purchasing it for an enormous profit. For example, Blackstone purchased Hilton for $26 billion, using only $5.6 billion of their own money, and generated a $14 billion profit in the process. On the other hand, if the company does fail under private equity ownership, the private equity firms will still walk away with substantial profits. Toys R Us is a prime example of how private equity firms can benefit regardless of whether or not the companies they invest in remain operational. As a result of the bankruptcy of Toys R Us, KKR, Bain, and Vornado were left with over $5 billion in debt and continued to receive fees on the $400 million a year the company was required to pay in interest prior to filing for bankruptcy in 2017. Insurance companies, the world's risk spreaders. Insurance companies such as State Farm, Allstate, Geico, etc., receive monthly premiums from millions of individuals and make promises to pay for problems and calamities should they occur. Auto accidents, fires, medical bills. Because not every individual experiences disasters simultaneously, this allows the insurance company to function. After collecting these monthly premiums, insurance companies do not just store them in an account. Instead, they utilize the money collected through investments in bonds due to their stability, along with stocks, real estate, private equity, and venture capital. Therefore, each month you send your insurance premium to the insurance company, your premium is utilized within global financial markets. Venture capital, global gamblers. Venture capital firms such as Sequoia and Andreessen Horowitz collect large amounts of money from pension funds, endowments, and sovereign wealth funds, and then utilize that money to fund high-risk startup ventures. Everybody understands that a majority of the startups will ultimately fail. It is acceptable for the majority to fail since only one needs to be successful in order to create a significant amount of value. This is referred to as the power law. When venture capitalists invest in 100 startup ventures, 90 of the startups will ultimately fail. A few may break even, and potentially only 2 to 3 may succeed and provide returns of 1,000 times or greater. An example of this was when Founders Fund invested $500,000 into a small social networking site called Facebook in 2004. And by the time Facebook went public, that investment had generated over $1 billion. When you look at the overall picture of the financial system, it can be viewed as a single, large-scale machine. Central banks are responsible for setting the money supply and interest rates. Commercial banks serve as an intermediary between savers, those who have money, and borrowers, those looking to obtain money. Pension funds help individuals stay alive during their retirement years while funding private equity and venture capital investments. Mutual fund organizations allow individual investors to invest in diversified portfolios of stocks, bonds, etc. Hedge fund organizations use enormous amounts of money to engage in extremely risky investments. Private equity organizations purchase companies and then sell them for a profit. Venture capital organizations invest money in new startup ventures with the hopes that at least one will become the next Facebook. Investment banking firms facilitate the completion of multi-billion-dollar transactions. Insurance companies provide protection from risks associated with investment, and many also act as major investors themselves. These entities all work together to move, create, expand, and even destroy money. As you go about your daily life, earning your paycheck, taking loans, paying insurance premiums, etc., you are contributing to the global economy through an invisible network of interconnected relationships among these organizations that support the operation of the global economy. Thanks for watching, and don't forget to like, comment, and subscribe to Money Mechanics.